Very important question that everybody discusses, what to do when the market crashes. Guys, I'm here to sit there and teach a process, but a big part of that process is having the emotional stability that when things look bad, you still stay on track. A lot of people have run these past studies to see how do people do versus the market. Guys, not only do people not match the market, they usually trail by 4 or 5% a year. Why? Because they make the wrong decisions at the wrong time. They buy more and more as the hype goes higher, and they sell when things look bleak. And it's understandable. When things are looking good, you can't imagine anything. I just always draw the analogy of your wedding. On your wedding day, the vast majority of you are probably like, this is the best day. I love my spouse so much. This is gonna be awesome. But is that the case for the rest of the time? No, of course not. Just like when you have a really bad fight with your spouse and you're like, I'm gonna kill this person. That's not fun either. You forget your wedding day. But that's the point of what I'm trying to say. Same with investing. Let's sit here and pull up the S&P 500 ETF. And let's go back to the max chart. Guys, this is going back to 1993 or so. Look at this. Things were awesome here, looked terrible here. Things were awesome here, looked terrible here. Things were awesome here, looked terrible here. Things felt awesome here, looked terrible here. Oh, but now they're pretty good. But what's the big key here? Now you might sit there and say, well, Paul, these are blips. Guys, this is the dot-com crash. Stocks fell 50-some%. This is the great financial crisis. Stocks fell 50-some% from peak to trough. This is COVID. Guys, everybody thought the world was over here. Everybody thought the world was over here. Everybody thought that the business world was over here. And guess what happened? Things still got better. When we're in the moment, it is so hard to see the good times when things are bad and you're in that moment. And when things are great, it's hard to see it's possible to have bad times. But guess what? Cycles are a guarantee in life. I always say there's 3 guarantees in life: death, taxes, and cycles. We're always going to have cycles. There's ebbs and flows, what people believe and don't believe. But keep in mind, if you have the right process and you dollar cost average into low cost ETFs all along the way, you would have overpaid at times and you would have underpaid. But overall, you'd have done this well. There are studies that show that the market does 9 to 10%. That's not a study, that's just a fact, right? With dividends. And there are studies that show returns as low as 3.5% a year over long periods of time for investors. And the highest I've ever seen is 7% a year. Look at that difference. Look at that difference. Huge difference. Let me show you how big a difference that is. Here's our retirement calculator. It's awesome because it goes a step further and sees, do you have enough money for even to live the rest of your life? So let's say you're a 25-year-old who wants to retire at 65. You currently have $0 in savings, and your annual savings are $7,500. And you're going to increase that every year by 4%. Now your returns, if you put in a low-cost ETF, let's call it 9.5%. And during retirement, you will make 6.5%. And you're going to live to 100, and inflation is about 3.5%. And you currently make about $60,000 a year. So I've made a lot of assumptions here. And you want to live the exact same life. So you want 100% of your income as it grows. Hit the generate button. And guys, you're pretty close, but you need to save about $350 more per year to retire and live the rest of your life great. But here's the thing I want to show you. At 65, you would have $4.95 million. Now, what's funny is, what's so great about our software here is, the average financial planner will tell you, hey, you got $5 million, you have enough money. But they're not factoring in what you spend. And if you actually go broke by the age of 98, pretty close to the end. But either way, now let's say that 9.5% return becomes 4% because you're emotional. Guys, you need to save $31,000 more per year. You're saving $7,500, you need to save $38,000 a year. And guess what? At retirement, you have $1.5 million and you're broke by the age of 72, 7 years later. Now let's say you're one of the good investors and you get the 7.5% return that I talked about. Hit generate. Guys, you still need to save $6,000 extra per year, almost double. At retirement, you have $3 million, but you're broke by the age of 80, 81. That is what happens when you make emotional decisions. This is exactly why I created this channel and created this community. It's all about taking the emotion as far away from your decision-making as possible. I don't want you to have to rely on your kids and your family members to live your life for you, to pay for your life, or the government. I want you to be self-sufficient. And the more emotion you remove from the situation, the better you'll do in the long run. Because the bad returns are not because of chasing things, chasing up markets and buying companies at overvalued prices, and also selling in the down market because you think the world's going to end. The world is not going to end. That's why a long-term ETF that follows the market is so great. It'll put the stocks in and out for you. You don't have to think about individual stocks. You have to be calm during bear markets, during crashes. Because guess what? Every crash in history, including the Great Depression, where stocks fell 86% from peak to trough, still the world ended up better afterwards. COVID, at the bottom of COVID, people thought the world was going to shut down permanently. Those were literally conversations happening. In 07 and 06, I met with friends of mine to help them with retirement. And I said to them, guys, if stocks fell 50% tomorrow, what would you do? And the wife said to me, we buy more, right? I'm like, perfect. She gets it. Fast forward, crash occurs in 08. I get a frantic email in December of 08. Paul, what's going on here? What are you doing? I'm buying more. Remember, we talked about that. Well, yeah, but it's different. The world's ending, the financial crisis. I don't want to lose all my money. I'm like, oh, well, guys, guess what? For stocks to become cheap, it has to feel like the world is ending. It has to feel like you're going to lose all your money. That's what makes stocks so cheap. And for stocks to go up so much, it has to feel like the world's never going to stop growing, that things aren't going to stop being great. That's what makes them go up so much. But if you're able to remember this, and you're able to remember history, and you're able to be around the right community of people who are going to talk you through it, then you'll be fine. You're just going to stick with it. And if you're prepared by learning about individual companies, by watching our videos, when things are bad and stocks are falling, you'll have the ability to then buy individual companies at better prices. It's amazing to me. Look at a company like PayPal. Look at a company like Alibaba. Those stocks are down 80% from their all-time highs. And yet I hear more negative stories now than I did when they were at their all-time highs. Why? Because the news follows the stock price, not the other way around. The companies are more profitable today than they were at their all-time highs. They're selling at better multiples than they were at their all-time highs, yet people like them less. Why? Because the stock has fallen. You've got to remember that. So all I'm trying to get you to take away from this channel is sit there and say there's a certain mindset you need to have to be a good investor. The good news is the more people you're around with that mindset, the better you'll do. I have found that about myself. I listen to basic investing books and I read basic investing books still to this day. Why? I want to repeat the same things over and over in my head. It'll all be okay. If I pay the right prices for good companies, it'll all be okay. And don't get me wrong, I still fall for the emotional side of things. I have to wonder, am I wrong here? But the good news is if you buy a long-term ETF like SPY or VOO, you're buying 500 companies that they're going to go in and out as the companies go under or get bigger. You're always going to be invested, and you have to think about what companies you're investing in. All you have to think to yourself is, I'm buying every single month. I'm buying every single quarter. Sometimes I'll overpay, sometimes I'll underpay, but over a long period of time, I'll get the market return. And you will beat 99% of other investors. So again, guys, follow me on Twitter @PaulGabriel, and I appreciate your time.